Hey, how you doing? This is Adam Post, publisher of more than 1,000 comic books and marketing expert covering Disney. This is Disney's total collapse. We're watching it happen in real time. It's hard to believe because it's not entirely necessary. Yes, they have the woke stuff and they should stop it with producing woke content and destroying their beloved franchises. But they actually have a lot of revenue coming in. They have a very significant business in multiple business areas run by generally intelligent and capable people. There's no reason for Disney to have to collapse, except something is just wrong over there. It's like the Afghanistan withdrawal when the United States left Afghanistan and didn't even tell its partners, other countries who had diplomats and people in the country. This is an Afghanistan level event. Let's get into the story. Before we do, please be sure you are subscribed to the channel. Click the bell for notifications. Give me a thumbs up. I really appreciate you guys. I'm trying to get to 30,000 subscribers, so if you can't subscribe, please do subscribe. Okay, first things first, the stock is doing really badly. It's been doing badly, but today it's been as low as in the 70s, which Disney has not had for quite a long time. Why is the stock falling apart? Because apparently nobody really wants to buy it. There's a threat going around that Disney could have a Bud Light moment. Keep in mind, there are a lot of people that have not written off Disney and have not looked at Disney as a very poorly managed company. They've just looked at it as a company that has secular challenges, such as changes to the industry, changes to streaming, changes to management. Things happen, but they still have these beloved brands. People really haven't drilled down and don't really understand that this company has really blown itself up. I can't describe how badly Disney is now being managed. I actually never thought Disney could be managed this badly. And when I say never, I mean up until like last Friday. I would have never thought that people who are so capable, people who are experienced, a lot more experienced than I have, managing multi-billion-dollar organizations that have complicated relationships, multiple contracts, different kind of industry understandings. I never thought that Disney could possibly be run in such a slipshod way. But when Charter Communications, Disney's second biggest cable vendor, said, no, we will not do a new renewal, especially not at a higher rate. You need to give us a completely different deal. And it came out in the public. That's when I realized, okay, it's not just the woke stuff. It's not just some industry stuff. Disney is being run by people where either politics is in control, and I'm not talking about lefty politics, I'm talking about like corporate politics, or there are people that are just completely not paying attention. Disney, in its current structure, cannot continue to exist. This is coming from Bloomberg today. Disney's $218 billion loss, not enough for dip buyers. Disney's stock is down $218 billion from its high in 2021. People are just not picking up the stock as an opportunity to, quote, buy the dip, buy when it's low, and get into a great future opportunity. They won't touch it. Not even the cheapest valuation since the COVID-19 pandemic is tempting investors to buy Walt Disney shares. Losses in its online video business and a drop in subscribers to its Disney Plus streaming service are just some of the issues it faces. Then there's the impact of the Hollywood actors and writers strike and a fee dispute with the second largest U.S. cable company, which has seen Disney yank its channels, including ESPN, from the service, cutting access for millions of viewers, up to 15 million viewers approximately. But it's not just that. Whatever deal Disney is ultimately forced to accept from Charter, which is going to be how it's going to go, Bob Iger has no leverage, absolutely zero. He can take ESPN and FX away from Charter. Charter could care less. The deal that will get done, and there will be a deal done, will be the deal that Charter says they want. Disney has zero leverage because they haven't been managing their business properly. But the issue is not just with Charter. Disney is going to have to adjust its deals with its other cable providers to match whatever they offer Charter. These deals are done on a most favored nation basis, meaning if they make a better deal for ESPN and the rest of their channels with one cable provider, they're forced to offer that same deal to other cable providers. And don't miss how important this is. Disney's cable business is many times more important than their movie business. For example, just one report from August 2023, Disney's linear networks generated $6.69 billion in revenue and $1.89 billion in profits for the quarter. That was down 7% and 23% from the period earlier. And what does that tell you? First of all, the cable business is many times more important than their movie business. They can lose $1 billion a year in movies. They can make $1 billion a year in movies. Kind of doesn't matter to them. It does matter when $1.89 billion for a 3-month period is threatened. And that's what's going on right now in the cable business. With revenue down 7% and 23% reduction in profits, what does that tell you? That tells you that every dollar that comes out of revenue is a major hit to their profitability. And it's not like Disney runs their profitability very well. They have very high overhead. This could potentially wipe out half or more of all of their profitability from their linear networks, which would be, $4 billion a year in income. This is not a number they can afford to lose. Quote, I don't want to own it for the near term, and I don't know that I want to own it for the long term, Nancy Tengler, Chief Investment Officer at Lafler Tengler, said of Disney stock. She counts the fee standoff with Charter Communications among her main concerns while calling for a dividend reinstatement. Her firm sold most of its Disney holdings in 2021. That was smart of her. The world's largest entertainment company is in the throes of a major upheaval, having launched an extensive cost-cutting drive after the return of Chief Executive Officer Bob Iger in November. That included 7,000 job cuts and other reductions in spending. Disney stock has lost about $218 billion in market value since peaking at $367 billion in market value in 2021. The reduction in market value is if you took all of their stock, added it all together, that's how little it is now compared to what it used to be. It's priced at a below average 17 times profits projected over the next 12 months. That's down from a peak of 77 times in the late 2020 when rock bottom interest rates and exuberance over streaming businesses sent the stock soaring. By comparison, Netflix has rallied 51% this year, meaning it's up 51% just this year. It now trades at about 31 times forward earnings amid improving profitability and resurgent streaming subscriber growth that the company has attributed in part to a crackdown on password sharing, which was brilliant for Netflix, and of course it worked out for them. They were allowing their customers to share their passwords, which made their product ubiquitous. Everybody had it, everyone got used to it, and then just like drug pushers, they take away the free drugs, and then they start charging for them, and the people who are addicted continue to pay. Disney, whose shares are down 6.8% in the same period, is planning a similar move. Disney is not even technically savvy enough to go ahead and pull back on the password sharing that Disney has been allowing. They just really don't know what they're doing over there. The impact of Hollywood strikes on media companies' content pipelines are becoming a bigger problem the longer they go on. Warner Bros. Discovery trimmed its full-year adjusted cash flow forecast, reflecting the assumption that the strikes will have a negative impact of as much as $500 million, which for Warner Bros. Discovery still leaves them billions of dollars of positive cash flow. Don't worry about those guys, they're just fine. Netflix, with the largest library of content, likely has the largest cushion in the industry. Quote, I would traditionally be one of the people that would be buying Disney here, said Ross Gerber, co-founder and chief executive officer of wealth management firm Gerber Kawasaki Incorporated. However, the strike is making him, quote, increasingly nervous about his entertainment investments. Disney is also in the process of buying Comcast's stake in Hulu and selling its TV networks, including ABC and FX. Who's going to buy their linear business now? No one's going to buy that because it's not even clear how much revenue they can get from cable providers. Gerber said he'd like to see an end to the labor dispute as well as profitability achieved for Disney+. Good luck with that, Gerber. And the sale of ESPN. The sports network could be worth as much as $30 billion, according to KeyBank. Wedbush put the potential price tag at more than $50 billion. Wedbush put that price tag there, if I'm remembering correctly, back in 2014, a very different business environment than they have today. Who knows how much revenue they're going to get per subscriber anymore from ESPN as the cable companies absolutely eviscerate Disney's cable business. Disney has no leverage in the cable business because these cable companies have been going into different business lines, from long distance service to cable service to internet service to offering different video products, because there are so many different video products now. You don't really have to have video products even if you're a cable company. A couple of them with 500,000 subscribers don't even offer a video product. Charter would be the biggest company to not offer a video product, but that's not what their plan is. Their plan is to offer video products, just not necessarily ESPN and the traditional bundles. Quote, it would be a great move for them to monetize the asset, said Gerber, because clearly Disney broken up is worth more than Disney together right now. That's one of the things that I've been saying. Disney is worth at least $100 billion more than its current market value if you broke it up in pieces, as long as the industry changes aren't so substantial that it becomes unclear how much revenue you can get from a division. ESPN doesn't just have sports licensing expenses. They have thousands upon thousands upon thousands of employees set up to deliver a certain kind of content for ESPN. It's not clear that's going to be profitable after the cable companies get done with cutting down on their revenues, because many more people pay for ESPN than actually watch ESPN, and the cable companies have had it with that. And why are the cable companies so frustrated? Because a lot of people are canceling their cable and they're taking cheaper streaming subscriptions for things that they actually watch. And here's something else that Bob Iger is doing that is absolutely outrageous. When I saw this, I thought to myself, I can't believe he's doing this, because you do not do this in the middle of a negotiation. Because if you do this, you cause a lot of bad feelings and people do not trust each other. This is from CNBC. Disney urges Spectrum users, that's Charter, to switch to Hulu Live plan. Disney has a competing live service plan, which basically includes essentially a cable bundle with local channels and cable channels, definitely including Disney's channels, as a direct subscription from Hulu. So you could tell people, oh, well, if your cable company doesn't want to do our deal, then you can just drop your cable company and work with us directly. That's a pretty competitive thing to do. So while you're in the middle of negotiations with your number 2 customer, who represent about 15 million of your customers for your content, you're going to go and compete with them directly and tell people to sign up with you. You can't do something like that and expect any goodwill to be able to make a deal. This is part of the horrendous management coming from Bob Iger's Disney. I'm sure the Disney people are very upset about what Charter's been doing, because it does damage Disney severely. But Disney should have solved this problem with them months ago, if not a year ago. They should have been in communication about how they can collaborate more. But obviously, because Disney didn't want to have the conversation, they kept putting it off until there was a disaster. And now there's a disaster. And here's Disney trying to get their customer's customer to cut them out and go direct with Disney. Well, that is the whole argument that Charter has in the first place. It makes the people at Charter have to have a conversation like, you know what? We need to damage Disney as much as we can, because look, they're a direct competitor. They're trying to steal our customers. Let's damage these guys. Let's wait them out. They're at a weak moment right now. Just terrible management from the Disney people. In addition to this, Disney is moving up the deadline with Comcast to settle whatever they're going to owe for Hulu. Okay, well, Disney's going to have to pay them a lot of money, because Brian Roberts is not managing his company badly at Comcast. He's actually pretty sharp. So Brian Roberts at Comcast brought up, Netflix is a $200 billion company. Disney has control of Hulu. Yes, the minimum price that we would accept would have been a third of $27.5 billion. However, that's an arbitrary number. That doesn't account for what Roberts sees as at least another $30 billion worth of value on top of the $27.5 billion to accommodate the fact that Disney is relying on Hulu, as any other streamer would, to help them market their bundles, including Disney Plus and any other streaming services. And there is no way that Comcast is going to agree to a price that doesn't incorporate the value of the market position that Hulu gives any potential buyer. It's a really dominant, important position. Disney is managing their business so badly, though, I would not be surprised that come 6 months to a year from now, after lawsuits are flying between Comcast and Disney over this, if the resolution isn't Disney losing Hulu. Because what Hulu should be is a distribution platform to provide access direct to consumer for multiple studios, not just Disney's streaming services. Because Disney, Paramount, Comcast themselves lose billions of dollars a year trying to set up their own systems to market their streaming service direct to consumer, and it's ineffective. In fact, Disney is now slashing their prices to $1.99 a month for a few months promotionally to get access to Disney Plus, the advertising supported version. And this is during their cable dispute. But it's not just about the cable dispute. This is available nationally, and they're tying it into the release of The Little Mermaid and Elemental on the Disney Plus service. The advertising-supported Disney Plus service actually provides them more revenue than their service that does not include advertising. Probably they should have a free Disney Plus service. I don't think this is such a bad idea, but everything Disney does is so badly executed. Who knows how this is going to turn out? But for people that are already spending $7.99 a month for an advertising-supported version, I'm not sure how they're going to feel about other people being able to sign up for $1.99 a month. Still, Disney is obviously desperate to try to get the subscriber numbers up for Disney Plus any way they possibly can. With $218 billion lost since 2021, their cable business completely up in the air, that represents around $8 billion in profit a year to them. It's such a substantial number. And the CEO of Comcast saying, look, you're going to probably owe me at least $20 billion. You better get your checkbook ready. I think Disney's about done. It's going to get pulled apart and people will buy pieces that they like, but they need to start waking up and talking to their customers, not necessarily like just their consumers, whether or not they like the content, but like the cable people that they count on for billions of dollars a year in income. They should be talking to and trying to figure out some kind of working relationship. But I do expect Disney to wind up ultimately losing Hulu. They just have no vision for the importance of the business, being an opportunity for other studios, including theirs, to cut their losses and be a real competitor to Netflix by really joining forces in an intelligent way. Let me know what you think of all this in the comments below. Always love to see your ideas. Please be sure you are subscribed to the channel. Click the bell for notifications, give me a thumbs up, and I'll see you again soon with another video. And if I don't see you, I will miss you.